when the fund earns the tag of being number one in its category, but the real challenge is not about getting there, but staying there.
We try to keep it very simple. We look at business performance. The fund performance follows what kind of stocks you're holding and what kind of business delivery is there.
Have you made any recent tweaks to the portfolios?
We have added to our more of consumer discretionary, domestic facing names. In terms of financials, we have moved from large cap banks to more on the side of NBFC and distribution businesses. But by and large, I think the kind of stocks that we are holding, we are very happy with the kind of performance they are delivering. We see that secular story to continue.
If you can take us through your allocation of the fund at this point in time, which sectors you're positive on?
Capital goods, which is around 20 to 22%, but there are so many sub-sectors within capital goods. For example, there will be transformer companies, there will be cable companies, there will be HVDC companies. Financials is around 20%, where again you have lenders, non-lenders, platform businesses, fintech companies. Around 8 to 10% we have in defense, auto. Within auto, we are more inclined towards EV, where we see adoption is improving.
A lot of the new age companies that you talked about, most of it does not really come with real assets, but they've got the market cap which large cap companies would have, right? So I'm sure your methodology would also be very different as to how you are valuing these companies.
So for us,
hello and welcome to another podcast. Well, my name is Shadaj Anand, and see, when the fund earns the tag of being number one in its category, but the real challenge is not about getting there, but staying there. Now, in the fast pace of the large and mid-cap investing, there are phases of market cycles, sector rotation, as well as customer expectation, which is also constantly evolving. And now in this phase, every decision counts, every decision is looked at. Now, to decode all this, we have with us Mr. Ajay Khandelwal, who is the fund manager at Motilal Oswal AMC. Ajay, thank you so much for joining me on this podcast.
Thank you.
Thank you so much. Well, Ajay, let me ask you, is there any aspect which the customers or which the investors are largely overlooking, especially in the larger mid-cap investing universe?
I think this is a very interesting category, which is relatively lesser known to investors.
Right.
And from our perspective, it allows us to allow the compounding to happen, which is our core philosophy. So Moti, as a house, we focus on few aspects of investing, which is generally QGLP.
Sure.
And that is more of quality, growth, longevity, earnings, and at a reasonable price.
Sure.
Now, we talk about flexi and multi as a category. Generally, if you look at these schemes across the funds,
Sure.
flexi is mostly benchmarked to large caps.
Exactly.
So the large cap proportion is much higher in flexi, whereas the category allows you to have the nimbleness.
Sure.
Large and mid cap, here the good part is we hold on to those stocks across their lifespan.
Gotcha.
And that is what I think we have demonstrated, where we have been holding stocks for a long period of time.
Okay.
And they have transformed from a small cap to multi cap and even a large cap. So I think this is one category which, as a fund manager, allows you to have a long-term view and let the business unfolds itself. And I think over a long period, that is what helps us to give sustainable returns.
Absolutely. In fact, when you started off, you did point out that this category is largely either misunderstood or not being, you could understand by the investors in its entirety. So how's the fund structure been built so that it helps investors to really understand what's really going on behind the strategy?
Yeah. So for large and mid cap, we need to stay invested 35% in large cap,
Right.
35% mid cap, and rest we have the flexibility to invest anywhere. Now, generally, if you compare it with the mid cap or a small cap, you need to be more like 65 to 70% invested in one particular category.
Yeah.
Here, for us, it starts with where is the earning growth in the market.
Sure.
I think that is the key point here.
Yeah.
So when we construct our portfolio, we try to look at spaces
Right.
sectors where the growth is higher than the industry
Sure.
generally, and the growth we believe that will continue for say 3, 5, 7 years. So irrespective of market cap, that is, I think, the starting point for us, which really helps us to hold these stocks for a long period of time.
Right.
And within sectors also, there are so many subsectors. So for example, in financials,
Yes.
if we believe that lenders will face difficulty, we look at non-lenders, we look at platform businesses, we look at distribution businesses. So there are different subcategories which allow us to look at to build an allocation in a sector which may not have that kind of representation in index.
Okay.
So for us, starts with having high earning growth, which is, I think, extremely important. And then we look at what is the right allocation for us in that, respective category and sector. So even though keeping in mind the sectors, but I think our positions are far varied from index, which people generally call what is the alpha position of the portfolio. I think that is where our portfolios are different placed. So that is one point.
Okay.
Second is in terms of looking at the allocation, we try and manage our risk in a way that because we run a 30 to 35 stock portfolio.
Right.
And this category, as I said, if something grows up from 2%, say to 4, 5%, I don't need to really cut down on my allocation. So we try and adjust our risk based on our allocation.
Sure.
So managing risk also becomes pretty easy in this category.
No, absolutely. It's like, finding the sweet spot when we are doing the allocation between the large and the mid-cap stocks, and you just find the right mix, which will actually help you, getting the right, getting the alpha that, you've been talking about, and the returns for the investors who have invested in the fund. Now, my next question is largely onto that. The recent past, we've seen periods of performance, and without actually going into the numbers, or if you want, you can go into the numbers. But what's really driving the performance? Is it the right mix? Is it the kind of stocks that you've picked up, the 30, 35 stocks, the kind of growth potential that these stocks have? What's really working for the fund?
I think what has worked for us is that we try to look beyond noise.
Okay.
Because what happens in near term, there are a lot of factors which impact. Now, especially in last 2 years, if you see, there have been so many events in terms of geopolitics.
Exactly.
Even close to home, we have seen so many changes happening. When we take a call, for us, it is always about how this industry is shaping up.
Right.
Those structural drivers is what we look at. Because if there is more adoption of that product happening,
sure,
it always happens gradually. I mean, you never see in 3 months consumer behavior changing.
Yeah, exactly.
But if you look 3 years, you will see there's stark difference in how we behave. I mean, look at AI adoption, for example.
Sure.
In ChatGPT came 3 years back, but now the adoption, at least at the user level, has changed drastically. So consumer behavior generally takes time. So we look at those kind of sectors where there's structural, changes happening.
Sure.
Just to give you some example, financialization of savings. Now, this is something which is happening, and we see that pace of changes even now moving faster.
In fact, we've been talking about financialization of saving for quite some time, but it really happened, I think, post-COVID, if I'm not
Absolutely.
wrong. Really, the kind of boost that it got post-COVID, I mean, that's really tremendous.
And just to give you an example, when we build our numbers, even we get surprised over a period of time how these businesses, the kind of profit pools they are able to create.
Right.
I mean, if you remove the largest FMCG company in India, some of these platform businesses are actually making more money compared to any of these staple companies that we have known for so many years.
Exactly.
So I think that transformation is something which we keep an eye on. that really helps us to avoid the noise.
Right.
Yeah.
Exactly. And in fact, a lot of the new age companies that you talked about, most of it does not really come with real assets, just like land or machinery, but they've got the market cap which a large cap company would have, right? So I'm sure your methodology would also be very different as to how you are valuing those companies.
This question has been asked in different form and shape. For example, people ask why some companies of our portfolio have high PE.
Right.
Okay. Now, when we talk about PE, we also need to understand what is the kind of capital which is deployed to bring that kind of earning. I mean, globally also, when we are talking about AI, look at the kind of capital investment going into that. And whereas you look at India, I mean, Indian companies are, the balance sheets are at decadal best in terms of their health. The debt to equity ratios are at 10-year low. So the earning is compounding without consuming a lot of capital.
Okay.
And generally, if that happens, you always get a higher multiple.
Right.
See, this is the difference between an asset intensive business and an asset light business.
Right.
The PE is always very different. So for us, we use our different methods to understand the kind of potential, the kind of growth these companies can exhibit. Because see, the market price is a function of how quickly they are covering that kind of opportunity and how the overall addressable opportunity is expanding. That is why some of these businesses, these new age businesses, the stock price volatility is too high.
It's too high, right?
We try to focus, stay sharp on the numbers.
Yeah.
Because some of these stocks, I think in our portfolio, in the last 2-3 years, we have seen price appreciation of 200% and a drawdown of 50% also. Generally, when we talk about, when we study books, these are kind of examples which sound so great. But when things are unveiling,
happening on the ground,
that is when you have to stay focused.
Right.
You need to keep in mind that eventually the business fundamentals will trump.
Sure.
So for us, I think cutting the noise, staying focused on business, the kind of delivery these businesses are doing,
growth potential that business has,
right, and how they're expanding their overall addressable opportunity. All these things matter because in near term, there are always these factors such as if competitive intensity is increasing, there'll be pressure on margins. All these things will always play out. This is not the first time we are seeing.
Absolutely.
So I think we are able to focus more on fundamentals and stay away from the noise. And that is why you see our holding period is generally fairly longer than others.
Absolutely. In fact, my next question is largely from distributors' point of view, in case, they are pitching this fund to someone, and what are the key aspects which one can focus on? Is it the kind of potential that you just carried on, that we avoid the noise, we try and focus on the growth potential of the fund, or the growth potential of the companies that we include in the fund, that differentiates between us as well as the competition?
So I think the way we have constructed our portfolio, we have thought of it as a long-term portfolio.
As long-term.
Yeah. Right. So, see, our philosophy is simple. Businesses do not change in 2-3 months. You have to give them time. So you expect that these are the kind of businesses which genuinely will create wealth over a period of time, because they every day they are improving in terms of health of the business, and eventually it shows. So it is for investors who are patient, because there could be volatility in prices. This is what we have observed.
Right.
And secondly, we try to adjust in terms of risk adjusted returns by having a liquid portfolio. Secondly, we try to contain the risk through our asset allocation. So our weights, for example, if a stock where we believe a business which is at a nascent stage of growth, we start with a position of say 2%. Then over period, when the business delivery is better than our expectation and we see that there's earning upgrade cycle which is playing out, we add to that allocation. So generally because as I said, things are changing very fast.
Right.
we try to contain the risk also in a way that we make changes to our allocation. And we believe that these are all liquid large businesses. So generally our market cap is more than 5,000 crore. We don't look below that.
Okay.
And even in small cap, if you look at, hardly 2 to 4% of the portfolio would be below 10%.
Okay. Right.
So generally these are large scalable businesses with liquidity, which is good because that is equally important. And they have a runway for growth, which is multi-year according to us. So for distributors, I think they should think of their investors who are long-term investors and who need to stomach some bit of volatility in near term.
No, agreed. And good that you use the word volatility, because that is the phase that is going on right now. And we are in the market, and market goes through phases. And probably somewhere down the line, whosoever is holding the fund would have this thought in their mind: is my fund capable of navigating volatility? And the same question I'll probably pitch it across to you, that how has the fund bulletproofed itself, you could say that, in navigating situation or volatile situations, because we've seen some geopolitical concerns coming in. Crude is doing its own rounds, you could say that, but we don't know what could happen probably in the next, in the next 15 days to a month, depending on how the Trump commentary phases. But all these things are there, and there are basically the variable factors that comes into the play, which impacts the market in the short term. Not that the situation will remain fixed for the long term, but yes, in the short term we are seeing these phases of volatility. Just in thought from your side, as how bulletproof is the portfolio, how to navigate this?
So how we think of our portfolio construction is that we try to divide it in two halves.
Sure.
First one, where we believe that these are structured stories. The pace of adoption can vary between quarters and years. So that is where as I told you, maybe EV adoption, for example, financialization of saving is another thing. Defense now also is coming in that bucket, where we see a multi-cycle growth. So these are the kind of things which will continue to happen. The other half is where we believe that there could be macro parameters which are equally important.
Okay. Right.
So here we look at something like, what is the interest rate? For example, for financial lenders, it is very important.
Sure.
Similarly, if raw material cycle, where the gross margins and the supply chains are more susceptible to any kind of changes. So we try and bucket those kind of stocks into the other category and see that what are the macro parameters, what is our view on it, and how they'll be impacted. And then we try to adjust our allocation based on that. I'll give you an example. For example, last 2 years, even in financials, we made certain changes. For example, when we saw interest rate coming down, we added to our large banks. Then when we saw now that asset quality has come down, the credit cost has come down, and now it is a question of growth, then we added to NBFCs. Whereas if you look at the platform businesses, the AMCs businesses, the exchanges, which are more secular in nature, which are not impacted by any of these parameters, they are in the first bucket. So within a sector, there could be stocks which are first bucket or second bucket. So we try and adjust our allocation in this second bucket, where we believe that some of these near-term parameters may have an impact. So I think this is how we try to adjust our allocation.
Absolutely. Now, when constructing, especially in the large and the mid-cap fund, there's always this, comfort factor wherein, you want to stay more towards the large cap category, so that if there's any period of volatility, the downside remains limited. But then again, it is also important when to shift towards the mid-cap space as well, or increase the allocation towards the mid-cap, so that we can capture the the boost potential or the growth potential in that particular. So is there any tipping point that you would like to highlight on that?
If you look at the large caps, for example, 35% and a little higher than that is financials. Another 10 to 15% would be IT, oil and gas, auto, pharma. staples. So broadly, the index earning is coming only from few stocks.
Right, exactly.
And we are placed in those stocks. Similarly, in midcap, if I remove just one last year, where a lot of commodity stocks have done well, cyclicals have done well, but there are good structural stories in midcap. So how we go about constructing portfolios is that which are those industries which are doing well, irrespective of the category where they're falling into. So I think that focus is what we believe is the differentiating factor. So instead of looking from a large, mid or small cap angle, we look at industries which are better placed, are seeing tailwinds, and accordingly we position our portfolio there. So yeah.
Absolutely. No, valid point there that the positioning of the portfolio from an industry's point of view, so that we are capturing the growth potential irrespective of the category where it is coming from. No, valid point there. Now, Ajay, let me also get your viewpoint. How you sort of effectively managing. You say that it's number one fund in the category now, and the pressure is also like that. But obviously, market goes through phases, and there'll be phases when there could be a dip in the performance as well. I'm not saying that's happening right now, but I'm saying there could be. But we don't want that to happen. From our side, all best wishes for that. It doesn't happen, and you stay on top. But I'm just saying, from someone who is holding the fund right now, this is more of a, if in case they do see a phase like that, it's more short-term underperformance. There could be a reason of that, and because a lot of these market cycles depend on the internal as well as external factors, and more so for the external factors. So anyone who's any message that you would like to give to the investors on that part?
See, markets tend to surprise, and this is what we have learned over a period of time.
Yeah.
You expect one thing, and you always have to build a case that the opposite of that can happen.
Yes.
So from that perspective, I think
and there's a saying as well. We say never say never.
Never say. Yeah. So we keep it very simple.
Right.
I think this puts extra pressure. So we try to keep it very simple within the team. When we discuss, we look at business performance. Eventually, the fund performance follows what kind of stocks you are holding and what kind of business delivery it's there. So that way we keep it very simple within the team. I think all of us discuss intensively how the businesses are performing. We try to do more, legwork to understand if there are any problems which are coming. Because you need to figure that out, both the earning upgrade and downgrade cycle.
Okay.
And if you stay on top of it, then fund performance generally follows that. So from investors' perspective, I think if you look at our portfolio, you will figure out that these are the kind of industries which are seeing changes. Just look around you. These are all very relatable industries.
Sure.
So instead of looking at near-term to performance, I think it is more important that we stay on course. We continue to follow our process. The process has served well for us in the past, and we believe that if we continue to follow the same philosophy, I think the performance will follow. But generally, without focusing on performance, we look at more how businesses are shaping up. That takes a lot of pressure away from us. And I think this is what investors should also look at.
Right.
That you look at the portfolio, you'll figure out that these are the industries which are seeing those kind of changes. And
basically having an eye as to which industry or which sector could actually lead the next phase of earnings growth in that particular category. No, absolutely valid point there. And from my perspective, or from a fund perspective, you can also highlight, have you made any recent tweaks to the portfolio recently? And if yes, then why is that decision?
So in terms of portfolio construction, there are two ways how we make changes. One is when we believe that the business is delivering earning growth, which is in expectation. And if stock prices are running ahead of that, then we need to bring down the allocation. So that is one way of doing it. Second is when there is some adverse event which is played out and we do not have a grip on earnings that, for example, if you lose a large client, now we are not sure when that client is going to come back. So we do not have that kind of visibility about your earning.
Right.
In that case, we have to bring our allocation down.
Right.
But otherwise, if there's things which are panning out and earning expectation, they are actually beating the earning expectation, we try and stay on course. In terms of allocation, because some of the capital goods for businesses, for example, have done exceedingly well last year.
Okay.
So we have brought down allocation there, and we have added to our more of consumer discretionary, domestic facing names. Similarly, as I told you, in terms of financials, we have moved from large cap banks to more on the side of NBFC and distribution businesses.
Sure.
So these are some bit of changes which continue. We, as part of course, we continue to make those kind of changes.
Right.
But by and large, I think the kind of stocks that we are holding, we are very happy with the kind of performance they are delivering.
Absolutely.
We see that secular story to continue. So,
yeah. The story to continue, I'll take that. And apart from that, it's a big fund, and it's got the interest from investors as well. There's another aspect which a lot of investors want to understand is how do you manage the risk in the fund?
I think that is where it becomes very important, and especially for a fund like ours where we run 30 to 35 stock portfolio.
Right.
We need to make sure that the underperformers, especially, I explained to you how we figure out which are the businesses which are not doing well according to our expectation. So we try and compare our new idea pipeline with our existing portfolio.
Okay.
And suppose if we are working on 3, 4, 5 ideas, we compare it with our existing holdings and we try and see where is the upside. If there is a new idea which is a better upside, where we believe the earning growth is going to be higher for longer, we try and make sure that the portfolio reflects our highest conviction. That really is, I think, one thing which helps us in good stead. So one way of controlling risk is that this is where we try and figure out which are the stocks where froth is building.
Exactly.
They are running ahead of the expectation. So we try and prune down our allocation, bring down our allocation. So based on that, one is we bring down our allocation based on the earning expectation. We compare it with new ideas. Second is what is the liquidity? These stocks generally in large and mid cap, you will see that we have stocks which are there in future and options. Because if the stocks are present in future and option, you have better liquidity in those stocks. Because it is equally important. So second is that. Third is within risk, I think we do not try to catch falling knives. That is another thing. Because see, if something is going wrong, we try and figure out what is it. As a prudent risk measure, we try and see the coming quarterly results. We try and do more of the groundwork, understand. So we avoid to catch falling knives. That is another thing which is there in generally our investment philosophy. So these few things that we take care, and we try to make sure that we do not go wrong in some of these basics, and that helps you to deliver, risk-adjusted returns.
Absolutely. So avoiding the contra bets, we could say that.
Contra bets, I would say, without seeing any kind of earning reversal.
Exactly, right.
Is something which we stay away. I mean, you will not find us holding a stock just because it is low PE, where we do not see any kind of earning reversal.
Right.
That is one thing which you will not find. If we have something represented, if we are buying something, it is not because it has XYZ percentage in the index, or secondly, it is moved to XYZ PE or a dividend yield. There has to be earning traction. Otherwise, it will not come into our discussions only. So, see, the whole team, the idea is to bring discussions to a level where we talk about earning reversal, earning acceleration. So, I think that is where
So, there has to be a story behind it, how the earnings will sort of, go from point A to point B, and and focusing on the future and not mostly from the present, but yes, present is definitely the starting point. And from that, my last question to you would be, if you can take us through your allocation of the fund at this point in time, which sectors you're positive on, that will also help investors. Yes.
So, in terms of sectors, we have capital goods, which is around 20 to 22%, but there are so many subsectors within capital goods.
Sure.
For example, there'll be transformer companies, there'll be cable companies, there'll be HVDC companies. So within sectors, there are subsectors which cater to different part of the value chain. Apart from that, financials is around 20%, where again you have lenders, non-lenders, platform businesses, fintech companies. So that is around 20%. Then around 8 to 10% we have in defense, auto. Within auto, we are more inclined towards EV, where we see adoption is improving.
Right. Absolutely.
Staples. Within staples, also we see more of businesses which are moving towards say quick commerce.
Exactly right.
Catering, they are ancillary plays to staples. Premium consumption, where we believe that the way per capita income in India is improving, there will be a natural curve which will follow in terms of consumer consumption behavior. So in terms of premium consumption, we have between 8 to 10% kind of allocation. So this is how we are placed. Then we have niche businesses, for example, in pharma, where we believe that there is the whole GLP-1 adoption, which is shaping up across the world. So some of these niche themes which are playing out whether in India or across the world, where Indian businesses are participating. So it's a good mix of companies and sectors where we believe that earning growth will be very high for next 2-3 years.
Absolutely. Well, on that note, thank you so much for taking the time out. And yes, managing the number one fund is not easy, but it comes with own set of requirements or challenges. But I'm sure you're leading the way. Thank you so much for taking the time out and joining me on this podcast.
Always a pleasure. Thank you.